Hi everyone, and welcome to Stock Market Education for Beginners series. This is part 1, Market Cycles, and I'm Greg Kilpack, President and founder of MarketTimingUniversity.com. Here's why you should listen to what I have to tell you. I'm a market professional with 25 years experience. I have a lot of varied experience in the industry. I've worked in financial services and in trading, as well as trading and investing my own funds. I've also read hundreds of books about the markets, and I've learned a lot over the years, so I'd like to share with you some of the first concepts that you need to know to be a successful investor. First off, this is investing, not trading. Investing and trading are very different in terms of risk and strategy involved. Investing is holding on to stocks for long term, months to years, whereas trading is holding on to stocks for minutes, hours, or days. And we're not talking at all about trading, it's only investing. Now, other investing education programs don't teach critical concepts. I know about these companies, they teach lots of good and useful concepts, but they don't teach you some of the critical concepts that you need to know and strategies needed to maximize your profits. Here's the first thing that you need to understand about how to make big profits over time as an investor. If you don't understand this concept, it's going to be really hard to be successful. And that's regarding market cycles. In the stock market, timing is everything. Did you know this? When you buy stocks is just as important or even more important than which stocks you buy. You can buy the stock of a good company at the wrong time and lose money, or you can buy the stock of a bad company at the right time and you'll make money. Timing really is critical. If you know the cycles of how the stock market works, it'll help you buy and sell at the right time. It does you no good to buy a stock at a good price if it goes up and then it just comes right back down in the next recession. That's not going to help you. You need to be able to buy it and then sell it when it's at the top. Now, this is called the top-down approach to investing. It's looking at the national economy first and then deciding when it's the right time to buy and sell. And I very much agree to this approach. Now, here's why investors lose money. Due to losing money in the last recession, that would be right down here, 2000 to 2002, the market goes down about 50% in value in this case. And then the Dow Jones Industrial Average comes back and the economy is improving. You know, investors got so burned during the recession and bear market right out in here that they're fearful. And even though the market is improving, they don't start buying until typically around here. This point, right around 2006, 2007, 2008. Everybody seems to look back since they don't know the cycles, and then they think this is the way it's going to be in the future. Without knowing the cycles, you don't know when it's time to sell and when to buy and how long the cycles are going to last. So amateur investors buy around here. The market may go up a little bit up to here, but then the next recessionary bear market comes along and they get creamed. And what happens is the market goes down, it drops until right around number 2, the market has dropped so far, they're experiencing so much pain that they sell. And that's right about the time when they should be buying, right around number 2, somewhere down here. And this cycle happens over and over for amateur investors. They don't know when to buy or when to sell, and they end up losing money. Now compare this to a market professional that lived 200 years ago. Baron Nathan Rothschild of the famous British banking family said, "I never buy at the bottom, and I always sell too soon." Let's go back to that. What he's saying is, he never buys at the bottom. He waits for the bottom to bottom out, and then he buys somewhere up here, and then after the crash, and then he buys, and then the market goes up, and then he's made a good amount of money. And he says he always sells too soon. So maybe he sells right at number 1, before the market tops out. He doesn't care if he didn't catch the exact high or the exact low. He still made a lot of money. Now, Nathan Rothschild lived from 1777 to 1836. Isn't it interesting that these same principles still work? These same principles of market timing still work and haven't changed in 200 years. That is very interesting. Take a look at this chart. Keep in mind that the Dow Jones Industrial Average represents what most stocks are doing at any given time. Most stocks follow the same direction in price that the Dow Jones Industrial Average is following. So here the market topped out in October 2007 right here. And the Dow was at 14,200 approximately. I just did a rough estimate on prices there. Now, take a look at all these stocks in column 1 when the market topped out. Wouldn't you say that all these stocks are good companies? I would say, yeah, I would agree with that. So at the market high, these were their prices. March 2009, when the market bottomed out, the Dow Jones Industrial Average had lost over 50% of its value of the index. Look at what most stocks did. They also dropped considerably, some more than others. But you'll notice that they're trending in the same direction. So it doesn't matter which one of these stocks you bought back in October of 2007 or thereabouts. If you held on, you lost money no matter which stock you bought. It doesn't matter. Okay. However, no matter which one of these stocks you bought somewhere near the low in March of 2009, you've made money on every single one of them. However, some made a lot more money than others. So timing is critical, but if you know which stock to buy also, you'll make a lot more money. So the implication is that stocks trend in the same direction. It doesn't matter what you buy. If you buy at the wrong time, you will lose money. And you'll lose money on all your stocks if the whole market is dropping at the same time. Also, it doesn't matter what stock you buy if you buy at the right time, because you'll make money with just about any stock. Very important concept to understand when you're investing. So, what is it worth to you to know when it's the right time to buy and sell? How much did you lose in the last recession? How much would you be willing to pay to avoid those losses and turn them into gains? How would you like to learn how to buy near the bottom and sell near the top? We teach these things at MarketTimingUniversity.com. I know from personal study how to do this. I've learned how to see recessions coming and to sell before the market erases 50% of your value. You can do that. Now, this is a concept that most people don't actually believe, but I know it's true and I can prove it. Learn to buy when prices are low and sell when prices are high. Take action. Join my YouTube channel to see more free videos coming up. This is just the first video of a series. I'm going to give a lot more free information in coming videos. Tell your friends about me so they can make money too in the stock market. And for special offers, go to MarketTimingUniversity.com. Thanks a lot. This is Greg Kilpack, and I hope you have a great day.